All right, everybody, welcome back to another edition of Market Talks with Dr. Stocks. This is Dr. Tom Carr, aka Dr. Stocks of drstocks.com, coming to you from our live trading room in the beautiful Southwest Florida beaches. We're not actually quite on the beach, but we're not too far away. And we've got some rather rainy, gloomy weather outside today, and that matches where the market is at, which is red, 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 just about everywhere you can find, with the exception of a few consumer defensive plays. But man, it is a nasty day in the market, and it's been a nasty 3 to 4 weeks for the market, which is a fairly long, prolonged pullback. Let's call it a correction because that's what it is. Anytime you hit 10%, it is a correction. The Nasdaq is already down about 12%. The S&P is nearing that 10% level, and I don't know where the Russell is. It's well underneath its 52-week highs. All right, probably in a bear market, actually. So it is what it is. We've got a macro environment that's not real conducive to stocks and could, in fact, be causing a recession sometime soon. We've got tariffs. And there's the ever-present threat of World War III, although I haven't heard much really about Russia, Ukraine in the last few days. It's just really been all about tariffs and every word that comes out of Trump's mouth. And we've got some, there was a whole lot of hope going into Bitcoin on a strategic reserve put together by the federal government. And that news came out on Friday, and Bitcoin has just been cracking ever since. Down 10% today, just today alone. So, yeah, it is what it is, folks. As I often say, we can only trade the market we have, not the market we want. And the market we have is not a very good market, at least on the bullish side. And the thing is, the sell-off happened. I'm going to make this excuse, but it's true from my perspective. The sell-off happened so fast, really just the beginning part of last week and then today, about probably 40% of the 4-week sell-off that we've had has happened in about 3 or 4 days. And if you weren't short going into those days, it was a little too late, my friends. And last week, we had 2 really nice looking bullish reversals, just to throw everybody off track. 2 big bullish reversals in the chart, including Friday of last week was quite a nice day. And nothing has followed through on that. All right, so if you're interested in joining me in the live trading room where we go over the market pretty much every day, and I tell you what I'm trading, entry price, stop price, target price, and reasons for the trade, join us over on drstoxx.com, drstoxx.com. Go to the subscribe button, scroll down to the live trading room, and we also have a brand new options room, and you can join both at a discount. Okay, let's look at charts. So we'll go over to our trading view chart. This is the daily chart, and we have on here, and you can see how ugly it is, the NASDAQ 100, big red stick today. Now, let me show you what I was talking about for last week. Actually, prior to last week, we had a Friday close that tagged the bottom of the linear regression channel just above the 200 period moving average and closed strongly green on pretty decent volume, and that what is that? Today's Monday. That's the Friday reversal. Thursday, Wednesday, Tuesday, Monday. Yeah, it was Friday. Friday of the prior week, we had a nice looking bullish reversal at a key level of support. Lots of folks were saying the pullback is done. Tariffs are priced in. No recession on the horizon. Earnings still pretty good. And then it was a gap up on Monday and a go all the way down. And then we flushed out a whole bunch of lows on Tuesday last week. It was a classic reversal bar, or almost. Didn't quite get it. Was a classic bullish reversal bar, I should say, because if only it had gotten above the open, it would have been a classic. And we had a little bit of follow through the next day, looking at not a classic reversal bar, but a nice looking bullish inside day bar 2 times, where the market looked like it was going to hold and bounce, at least weekly, a week bounce, WEAKLY, a weak little bounce back up into the former broken resistance or back up into the 21 period moving average or even all the way up to the 50 to give us a retest from the underside. That's typically a good place then to take out and take profits on your longs, maybe flip to some shorts. Didn't get that chance at all. not at all. Every single bullish potential reversal morphed the next day into more downside, and that's pretty much where we are. So Friday last week we had a classic reversal bar. This is a classic reversal bar on the Nasdaq. You open inside the range of the previous day. That would have been Thursday. You travel all the way south to take out at least 20 days of new lows. Then you travel all the way north to close above the open of that day. Give yourself a green candle within the range of the previous day. It's a classic reversal bar. It's one of the strongest candlestick patterns in the market. And there was absolutely today zip on the follow through. The futures opened last night at 6 p.m. I was working at my desk, working on the newsletters for the trend trade, ETF, momentum letter, and on and on. And I could see that the futures were opening weak and getting weaker as I was working. And then this morning, already down about 2%, and it's only gotten worse from there. So it is what it is. And there's been some kind of weird things going on today. We've had cyber attack on Twitter, which is, it is what it is, but not convenient for those of us that jump over onto Twitter to kind of get a sense for what's going on both in the market and in the news, and haven't been able to do that. So a little bit like flying blind today. But then we have to rely on the charts, and that's pretty much what we do as traders anyway. So big red stick today. Now here's the thing I wanted to point out. You're going to see the same thing on the S&P, right? An even bigger red stick. The Nasdaq is down more on a percentage basis, but the S&P, well, I don't know. I wouldn't say what it is. No, it's not. The Nasdaq is just worse. It's just worse than the S&P today. Big red stick, and we're kind of looking, where is some of the support? You got to go way back to find these lows. You've got to go. We did close a gap today. That's one little bright spot, but you got to go all the way back to September last year to find prices as low as they are now. That's wiping out. Now here's a good point, by the way. This wipes out all of February, a little bit of March, all of February, all of January, all of December, November, October, and most of September. So that's about 6 months, like half a year. We've wiped out half a year of gains in 3 weeks. The first week of this sell-off was pretty minimal. The second week was bad, and the third week was bad, and now we're into the fourth week, and it's also bad. So 6 months of profits in the market has been wiped off the board. Now, if you look at your own account, if you are where you were back in September in terms of the capital that you're trading, if you're exactly where you were back in September, you can kind of pat yourself on the back. You're performing as well as the market. You're not doing any worse. If you're ahead of the market, which is kind of where I am, at least I'll say that, and where the room is and where our newsletters are, if you're ahead of the market, if you still have profits that you go back to September and see where your capital was back then and where it is now, even with all this sell-off, if you're ahead, you're doing okay. Yeah, you're doing something right. You're protecting your capital. You're not taking huge risks. And yeah, I have to admit, I've been doing some of the buying on the dip kind of thing that makes me look like I'm amateur hour, right? I'll take it. It is what it is. Because those reversals that we saw in an oversold market at really deep lows like that, especially at the 200 period moving average, is typically where in an ordinary market you get at least a week or so of good bounce off of that. We got nothing. We got absolutely nothing. Okay. Now here's a couple of bright spots. The RSI, very important indicator, not just because it indicates oversold conditions, but because a lot of big funds key on the RSI for the determination of inflows. Right? So they'll stay out of the market when it's up above 70. They'll stay out of the market even when it's above 65 or so. And they put their new cash into safe havens and into bonds and cash and things like that. When it gets down to below 40, they start to trigger buy signals for mutual funds and for hedge funds and others. And they'll start distributing that money among their main holdings. Now it's below 30. So you can imagine that not only are they starting to buy, but now they're buying in greater size. That's just how smart money works. Smart money buys when things are weak, when blood is in the streets, and they start to take profits off the table, as Buffett did. I mean, he was a little bit early, but Buffett got to cash a long time ago. They take money off the table when things get a little bit too rich, valuations a little too high, momentum a little too strong. So we're at that place where funds should now start to be increasing their buy programs. Where were we in the market when we hit that level? Where is it now? Let me just see if I can get a reading here. It's about 28. Where was the market when it hit 28 the last time? Well, we have to go way back. Here's one that tagged the 30. That's the August low. Low right there, that big scary stick, right? 3 big scary sticks in a row. What was that? The Japanese yen trade, I think, the carry trade. Correct me if I'm wrong. But that was, of course, a very short-term thing. It resolved pretty quickly, and the market flashed much, much higher very quickly. Real bounce back almost to new all-time highs. The next low signal down near 30 was back here in April. Don't remember what was going on in April, but it was before the election, so I'm not sure what was happening then. But that was also a buy signal. It didn't even hit 30. We have to go all the way back to the October low, right here, right there, the second October low. There were 2 lows in October, one early at 30, about 29, and one a little bit later, 28. Both of those were pretty good buy signals, one above the 200 and one like we are now below the 200. Both of those times were very good times to buy stocks. And at least the first time, yeah, you had to have kind of a quick leash. Now, when you buy off an oversold stock signal like that, your first target is the 21 period moving average. And when it gets there, you got to start lightening the load. Maybe it gets up to the 50, which is, there's no guarantee that that's going to happen, but you would like it to happen. That's certainly the time you would want to go to cash and then wait to see what the next leg is for the market. And it turned out that it was down. Then we had another 30. We had a 28. We had a 28 right there, maybe 29. On that very day right there, heavy volume. People are still abandoning ship, getting out, selling. And it turned out that was the low over the next 16 months, right? There was no lower low than that late October, which was kind of not quite, but it was kind of the end of the 2022 bear market. It was the last legs of it, the last concerns about recession and so on. And that's where we are again. So here we are on the S&P. We are below the 200. That's not a good place to be, but frankly, we were there last Friday and that didn't work either. But we are down at 28. This is actually lower than August, lower than April, lower than October. No guarantee, of course. This could go to 25. It could go to 20. It could go to 0. Could, right? In theory. I don't think it ever has. I don't think, in fact, you're not going to find an RSI below 10 anytime this side of the October 1987 crash. So, yeah, it just doesn't happen. But here we are at 28, the lowest since the COVID crash. And I'm not sure where the COVID crash went to because that was so fast, right? It was over and done with in a week or two. But here we are. So that's one little positive sign, right? The market is not telling us it's time to buy just yet. It is still flashing panic and selling and downward momentum and just, yeah, not a good time to buy. But the upside risk right here is massive because look, when you get down that low, you're going to see the bounce back is going to look like this, big green stick. The bounce back is going to happen. There's another one. That was the April low. And that, flash back up to the 21 in 3 days. Here's the late October low, and it was boom, 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 all the way up to the 50 without taking a break. That's the kind of thing that we are destined to see very soon. However, we're not there yet. Doesn't look like it's going to happen today, although today could, in fact, be the bottom. And I sincerely believe that we will need a catalyst. Now, we do have a catalyst coming up on Wednesday. CPI should come in really tame, way below expectation. So, Trueflation, which is always a good follow on Twitter, has an inflationary number about 1.5%. The market is looking tomorrow for the CPI, or sorry, Wednesday, CPI coming in at around an annualized figure of about 3%. So I don't think it's going to come in at 3%. Is it 3 or 3.2? Something like that. Anyway, pretty much flat with where it was last month, and a 0.3% on the month to month basis. 0.3% will probably get that, but I don't think it's going to be 3.2% or 3.3%, whatever it was last month. I think the annualized is going to probably maybe come in below 3, because I think a lot of consumers, they've closed up their wallet. They're sitting on their wallets. They're not spending right now. Not so much because they're seeing prices go up. Tariffs haven't kicked in just yet. We've been shopping and buying stuff, and we're not really seeing much in the way of an increase. But the fear of the increase coming down the pike is enough to keep people out of the market, out of the shops. All right, so snapback rally soon, not today, but very soon. NASDAQ, pretty much the same thing. We've got a break of the 30. Have to go all the way back to October to find anything as low as that. Every time we got anywhere near the 30 on RSI, boom, right back up, at least to the 21. That would be our first target. 50 would be our second target. And the third target, if we even get there, and I don't think we will, would be the midline of the LRC, right up there. So those are your three targets. I would be happy with a bounce back to the 21. Frankly, I would be really happy with a bounce back to the 21, and then I'll get to cash, and then we'll see where things settle. Right? Let's just do that. So I'll take a look at Bitcoin. It's really ugly today, but it is still above. It did break support. It broke a support trend line, but still above the 200. I don't know why the stochastics. My stochastics on TradingView has been really strange, and maybe I have the settings wrong, but it seems to almost go in opposite direction of the price. So I'm not even going to worry about that. But we are back down to the 30. Last time we got to the 30, there was a little bit of a weak bounce up to the 21. See how the 21 is like a magnet. Mean reversion, right? Reversion back to the mean. And there was a flip right over the next day. No interest at all in the strategic reserve. I don't know why, but it is. It's just what it is. All right. We do have a little bit of Bitcoin in the wealth building portfolio. I've sold almost all of mine except for that piece. I had some in my long-term trading account, but man, I don't want to get sucked into some sort of weird vortex with crypto. I don't know what's going on with it. I don't. And if I don't understand it, I'm out. For that reason, I'm out. Okay, so that's what's going on in the major indexes. The only glimmer of hope we have for a near-term bounce back relief rally, dead cat bounce, if you want to call it that, is that the RSI is now at the same level it was back in October 2023, which launched one of the greatest bullish runs in market history. Now, here's a couple other things I wanted to point out. These are pretty minor points, so nothing really to hang your hat on here. But for the S&P, let's blow this up a little bit. For the S&P, let me get rid of these lines. We are in the fourth week. Today would mark the fourth week of a pullback or downtrend or correction, the fourth week in a row without a break. That doesn't happen very often. In fact, if you go back to the COVID bottom, all the way till now, that's like 4.5 years, 5 years of market data, you will only find two other times where the market hit 4 weeks in a row on the downside before it bounced back up. This is on the S&P. Now, the NASDAQ is a little different animal, right? It tends to, because it's only 100 stocks instead of 500, it's mostly tech instead of a whole bunch of other stuff. So the NASDAQ tends to, it cascades down for a longer period of time. It rallies back up for a longer period of time. It does choppy things for a longer period of time. The S&P 500 is a little smoother and not as volatile. But just on the S&P 500, 4 weeks in a row doesn't happen very often. It's only happened two other times. And the second time was fairly recent. Let me see if I can find it. Da, 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 da. Nope. This is the weekly chart now, by the way. So we're looking at weeks, not days. Um, that's a 3. Okay, here's one. This is the one I wanted to show you. This is one of 2 pullbacks that were longer than 4 weeks, or longer than 3 weeks, I should say. This one happens to be 7. So let's keep this in mind that since COVID bottom, there have been only 2 times where it got longer than 3 weeks, but in one occasion it was 7 weeks. Do we want to sit through 7 weeks of drawdown? No, we don't. How low did the weekly RSI get on that? We started up here above the 21. We started up there with the 21 above the 50. We started there with a pretty good looking chart, right? Maybe this little, this is the beginning of the bear market, 2022, the very beginning of the bear market. And we had a nice little bounce back up, and then it rolled over, and then it was 7 weeks down in a row, and the RSI got down to 30. Where's the RSI now? It's at 40. Okay, so 40 is the lowest since that October low that I mentioned before. And that's really as low as it generally gets on pullbacks. But yeah, so I can't find the other one. I know there's another 4 week in a row pullback. Where is it? I thought it was closer to current price. That's the 7. That's a 3. That's a 3. You'll find plenty of 3s, right? Everything comes in 3s in the market. There's another 3. I don't know where it is. There's a 4. There it is, right there. Okay, so way back in August, September of 2020, right after the COVID bottom. There's your COVID bottom way down there. Happened so fast. That was not 4 weeks in a row, by the way. It was 2 weeks, then one little very weak relief rally, 2 more big weeks, and then you had the bottom, and everything was back up from there. How low did RSI go on a weekly basis? Way down there, right? So it can get lower. 20 was where it got on the COVID crash. The difference there, of course, is that was a total market economic shutdown. Businesses closed. Banks closed. Supermarkets closed. Shopping malls closed. Traffic gone. Travel, no way. Restaurants, everything else, right? It was a total shutdown of the economy. And the only way that people were able to survive is because the government was giving them money, right? Paying out money. So that was a very unusual situation, totally artificial, and a beautiful, beautiful buying opportunity. Now, we don't have anything like that now. The economy is still firing on all cylinders. Growth has still been pretty good. Yeah, I think evaluations might have gotten a little bit above where they should be, but for the most part, still we're nowhere near what that caused to the economy. It is, however, and this is the only thing I would make a comparison to. It is, however, a kind of fabricated economic slowdown, or at least the fear of an economic slowdown, because these tariffs are temporary. Right? Just as the lockdowns were temporary, the shutdowns were temporary. The tariffs, in theory, should be temporary if they're imposed at all. Now, I know we have some already in place, right? They went in place last week and again this week. So there are some in place. There are still some that would be applied. And at any moment, we can have some kind of a negotiation take place, and those tariffs begin to get rolled back. They are temporary. They're not going to be in place, I don't know, more than a couple of weeks, I would think. I should think. I could be wrong. I'm not involved in those discussions. They didn't ask me to be. But all of that's to say that we're at a place, technically, in terms of time, in terms of cycles on pullbacks, and in terms of what's going on in the economy, that we should be much closer to a really nice rally than to further horrible downside. That said, the downside is pretty horrible, I have to say. Now, you're going to see a similar thing. You've got 4 weeks down on the NASDAQ. We did break 40, so we're a little bit lower there. And the NASDAQ, as I said, does have more 4-week pullbacks than the S&P. but they're still pretty rare, right? Pullbacks generally come in 3 weeks with at least a bounce for the next week. And then if you're going to get more, it comes after that. All right. Now, that's all I want to say on the indexes. Let me just take a quick look at a few mags, and it's really kind of depressing. I have to say it's depressing. Who's the worst today? Tesla. Lovely. After we added our first tranche of Tesla shares into the wealth building portfolio, and we will add a second tranche, just not today. We'll have to wait until we get a little more clarity. Now, the good thing about Tesla is that it filled the gap last week, and it certainly looked on Friday like everything else did on Friday, like it was going to hold and give us a nice little bounce that would start today, and we haven't gotten it. It's a gap and go to the downside on heavy volume. The good news is that it is closing another gap. This is an earnings gap, and you don't really want to see earnings gaps close, but they do sometimes in a bad market like this. So we'll have to see that this holds. The low of this area here is about 220. So we're at 225, still have a little bit of downside room to give before we need to start worrying about support breaking, but not looking real good, at least anytime real soon with Tesla. It's a no-go zone for sure. Avgo is at the 200, so that's not too bad, right? I haven't looked at the rest of these, so we'll see. I do like Google, but boy, today was a very disappointing day. Some of that might be a distribution, but yeah, we are at, and this breaks now, finally breaks this long-term trend line that has been in place, I think, since the October. No, since no, it hasn't been. Unless maybe it goes back further. I think it does. Yeah, it's maybe at the October lows where that started. So not good to see that, but it is Google, and it will bounce back, of course, when the Nasdaq is ready to. We're seeing a little bit of bullish divergence here in the RSI, but not holding my breath. Facebook, I set it back up here above the 50-period moving average when we were already in the second week of the pullback, that Facebook had the best setup. That's no longer true. So we broke the 50, we broke that little range support, and it's just been like everything else, like everything tech, falling off a cliff. So it is quite near some support. We've got a volume shelf in this area down here. We've got the 200 still below us. Some good places for the Facebook to catch a bid, but not today. Apple was one of the better looking stocks as of yesterday. In fact, it's the only mag stock that really was green all day long, and was green the day before, or at least close to being green most of the day before when everything else was selling off hard. And Wednesday last week gave a nice reversal signal. It was below the wedge consolidation, then closed back up and gave us a green bar and pretty decent volume. And a little bit of follow through the next day, was up positively in a very, very red market, and then came back down to close right at that support. And then the next day there was the Friday follow through to the upside. Everything looked very good for Apple technically to get back on track, and it just collapsed today. So NVIDIA, there are some numbers here to watch. So you've got this volume shelf right here, these lows and open prices around 110. 110 is the number, and I do think if it gets back up above 110 this week, and it should at some point this week, maybe tomorrow, that it will squeeze the shorts out of this one. Not a good look today, however. With the break of that range support, we are below the LRC, and everything has just fallen off a cliff here. The LRC is down. The 21 is below the 50. The 50 is still above the 200. So long term, it's been one of the most successful stocks in the market. That's not going to go away anytime real soon. But man, this really needs to do some turning around. I don't know what else to look at here. Netflix was one of the stronger markets when it was up here around just under 1,000 in the upper 900s. It was above the 50. It was holding very nicely, a green bar on a red day, and then boom, boom, boom. Thursday, Friday, today. Nobody is safe. Nobody with any kind of tech exposure is safe, I'm afraid, in this market. Microsoft just keeps going lower. It's not been a healthy stock. It's been kind of a no-go zone for me, at least. I don't know when since, maybe back in this area, but it's just not performing well. And now it's below a long bullish base that could have done could have broken out to the upside with some market help, but not this week. Amazon, not horrible, I have to say. Amazon is not horrible. It held the 200 period moving average for several days in a row. It did have a reversal bar on Tuesday. That was turnaround Tuesday, and then follow through the next day. When you see a turnaround at the 200 after a pullback and a follow through the next day, and we had good volume, very good volume on that reversal bar. Follow through the next day, it's like 85% of the time you're going to get a nice multi-day rally out of that. Well, not in this market. Not in this market. Technicals are being thrown out the window because everybody's worried about the macro picture. Now, let me say a quick word about that. In fact, let me show you the charts. This is a good time to bring this over. And I will take a couple of chart requests, but I'd be surprised if any of you were that interested in just about any name out there except for maybe some of the defensive plays. There's some green. There are some stocks that are green out there. As the day wears on, they're getting fewer and fewer in between. Now, here's one thing to think about, by the way. Right, usually when the market's pulling back, especially with tech being so horrible and NASDAQ being so horrible, the first safe haven that people get into after bonds, and bonds are up today, I think they were up earlier, are the defensive plays, the consumer staples plays. Walmart and Costco are the top tier of that, but they just both got crushed on earnings, so they're kind of off the table. But then there are some other names like Coca-Cola, McDonald's, Pepsi-Cola, Procter and Gamble, Colgate, that tend to do, those kind of stocks tend to do really, really well when the market's weak, but also well during a recession. You can lose 25 to 30% of your portfolio value in a recession. But if you had all your money in those stocks during a recession, you might crank out a 2 or 3 or 4% gain. So it's not going to be much, right? Because in a bad market, everything is pretty weak, but the defensive plays do pretty well. But here's the thing. If this is temporary, and if tariffs start to come off, let's say by the end of this week or next week, or things start to alleviate a little bit because of some negotiating, you're going to see all that money that was put into defensive stocks pull out again and go back into tech, because that's where the alpha is going to be. Big alpha. I mean, like the kind of alpha that can change your life, or at least make your year. But, big but, we're not there yet. Okay, so you saw this chart before. Trump tariffs 101 in his first term was a temporary thing. It did cause the market to come back. It was a correction down 13, 14%. Then it was a snapback when the tariffs, and this was just on China. I don't think there were any Canadian or Mexican tariffs. Correct me if I'm wrong. But we had the big snapback when those tariffs came off, and then it was pretty much of an uptrending market ever since, because the economy was, in fact, very, very good. The economy is, in fact, still very, very good. And we're down here. We're actually a little lower now because this was a couple of days ago before Friday's reversal. Or was this after Friday's reversal? Anyway, we are lower, certainly. In fact, we're a fair bit lower because today is just horrible. With the S&P closing in on about 13% down, and I'm sorry, the NASDAQ about 13% down, maybe 14% by now. The S&P getting past the 10% mark. We're down there. We are down there with Trump 2.0. As I said, any little alleviation of the tariffs, we're going to see this kind of a move right here. So a little bit of hope there, perhaps. But I have to say, this time things are a little bit different, right? Tariffs are higher, and they're on more countries than 1.0. This is a ratio of high beta to low beta. Typically in a weak market, you'll see high beta names fall and low beta names outperform. That's what this chart is reflecting, right? High beta weak, low beta strong. And you can see the price is cracking. And this is from last week. This is not this week. It's even worse now. However, every time you get RSI down at that level, that blue line down there, that's been a buy signal every time, every single time. Right? buy signal, short-term buy signal at least, buy signal way down here at the lows, buy signal short-term, and buy signal quite a nice run. So we're there again with another buy signal here off to the right edge. And look at this. This is the lowest MACD in maybe forever on that ratio. I looked back a couple of years, 3 years, COVID crash, couldn't find anything nearly as low as that. So, yeah, talk about some extreme prints that we're getting with this pullback. Very, very unusual in terms of the extreme momentum that we're seeing, the quickness, the speed of these sell offs, which only means sooner or later, it's got to bounce back. This is another thing. So, a lot of money went overseas over the last several weeks, going into European stocks, which were really beaten down, going into Asia stocks, Latin American stocks, Russia, and so on. And with the ratio of global stocks to American stocks, it had been falling because the American market was so good after the 2022 bear market. American market was the only game in town. Then everybody, for whatever reason, maybe it was Trump, maybe it was the tariffs, right around a little bit after the election, started to take money out of American stocks and put them into other country stocks. However, I have to say this is the highest MACD reading on that ratio that I could find ever, ever, ever. You can go back 10 years, 20 years, 30 years. You're not going to find a stronger overbought condition than right now. What does that mean? Doesn't mean that it can't go any higher, but it does mean that we're going to see, because the alpha is not going to be abroad. The alpha is going to be here at home. You're going to see money starting to come back into the U.S. market. And this is good news, right? So a recession is typically, you get an early clue to the recession with a rising jobless claims. Jobless claims have been in a tight trading range for months and months. This is after the huge drop after COVID, right? It was really, really high. COVID came all the way back down, and now it's been very flat, right? 100,000, 150,000, 180,000. It kind of bounces up and down month to month, but it's not trending. It's not rising. It's not getting any worse. If we see jobless claims this Thursday crack above that black line, or getting if it has to crack the black line. If we see that in the next 2, 3, 4 weeks, okay, early tell of a recession. We're not there yet. So no sign of recession there. Fear and greed index down as low as it's been since the bear market. That's typically a bullish sign. This is the McClellan oscillator, actually showing a little bit of divergence here, bullish divergence. It hit the negative 50, which is usually a line in the sand, volume going out, coming in to the NASDAQ market. When it hits negative 50, that's usually about as bad as it gets. We hit negative 50 last week, and it has been starting to rise up a little bit since then. Those little bounce days that we got, starting to see more money coming into the market than going out. That's a bullish sign. However, this is not including today. Today's going to make things look a lot worse. We could be back down to negative 50 today. It's a pretty volatile index. But MACD, every time it gets down to that level and starts to bounce back higher, as it's doing right now, I don't know what today looks like, but that's what it was doing Friday. That's a bullish buy signal for the market. Buy signal, this one's a little squirrely, I have to admit. Buy signal, and we're there again. And last thing, so bullish percents, you'll find this over on stockcharts.com. Whenever bullish percents dip below 44 or 42, somewhere in that area, I don't know why that's a number, but it is. We tend to see market bounce back quite cleanly, and we're all the way down to 38. That means 38 stocks out of the NASDAQ 100 are on a bullish percent buy signal, and 62 stocks, the majority, are on a sell signal. And yeah, it can get worse. In fact, we go back to the COVID lows, you'll find it to be worse. You go back to the 2022 bear market, you'll see numbers down in the 20s. But typically when it gets down this low, you are pretty close, if not at a bottom. So we'll see where that goes today. In fact, let's do this real quick because I can look at it. It's a real-time thing. this is stockcharts.com. You go to market summary and you scroll down, and here we go. So, no, it's the next one down. Bullish percent for the NASDAQ 100. No, is that it? No, this is the one. This is the one. Yeah, the comp, the NASDAQ comp, the 2,000 stocks of the NASDAQ, which is down now at below 38. So definitely getting worse. Okay, so that's all I have for you all. Let me take a look. I don't have any setups at all. I'm sorry. I have nothing that I would want to buy right here. Nothing, 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 nothing. We're just in waiting mode, and we're sitting on cash, and we're protecting our capital, which is what we're supposed to do in a market like this. When it's too late to short, but too early to get long. Not that I haven't been trying, I have to say. Oh, slap me in the face. Yeah. All right, let's see what, if you guys are interested in anything. If not, then, well, TMO, I see a couple of things here. TMO. Thermo Fisher. This is a healthcare play, and as we saw earlier today, boy, look at this, just down, down, down. My goodness. Right now, here's your heat map. There's very little that was red. All of this area over here was pretty green earlier this morning. Red over here, you know, the big mags, the tech stocks, the banks, um, fintech, and on and on, all red. But there was a lot of green over here on the right side of the heat map. Those are your safety plays, right? Your consumer defensive up here in the right-hand corner, except for Walmart and Costco. Your utilities, always a safe haven play. Your telecoms, your energy, and your healthcare. So down here in healthcare, we had quite a few greens. Now it's starting to look a little bit more red. But healthcare is it a recessionary play? Not always because of the biotech stocks in there, but everybody's going to need healthcare. Everybody gets sick. People get sick and need a doctor and need a hospital and need medicine and need pharmaceuticals, whether there's a recession on or not. So that's one of the reasons why healthcare is such a safe haven. And TMO, let me take a look at TMO. I don't really know the fundamentals, so let me just take a quick look here. Okay, so this is, all things considered, any stock that's green today is going to be outperforming. This one certainly is. It's not quite green. I think it's a little bit red. Is it? Yeah. Yeah, it's down. It's down 5 points, but hardly down as much as the market. Where did I go? That's not what I want. Here we go. Okay. So you've got support down here at 515. It tagged that last week, bounced nicely versus the market off of that level. It is a weak bounce. It's now hitting the 20-period moving average. We've got this sort of rejection above it and pullback underneath it. That's not a good look, but I suspect, because volume here is also pretty light, it's been falling off, I suspect that this is just going to be a temporary little pullback. It might even be, this is thinking in 4D chess, it might even be a bullish sign for other sectors, because if money is coming out of the safe haven play, where's it going to go? Well, maybe it's going to go into tech. Don't think so. Don't think that's the case. But I would just be a little careful with this if you are long. But I have to say, not really seeing anything to worry too much about here. Obviously, the 21 is below the 50. The 50 is below the 200. It's not really a downtrending chart. It's more just a big trading range, and you're down near the bottom, at the bottom of that range. Don't see any major danger of breaking that line of support. As I said, it was about 515, between 512, 513, and 515. I don't see that giving way, but it may be a little while before it gets back up above the 21, and then it needs to test the 50, and that would give it sort of a, actually there is some divergence in here too. Yeah. Yeah, right off that bottom, there was a little bit of divergence, which is already playing out, so I don't think we can count too much on that now. Maybe come back and test this, or give us even better, give us a higher low, and then it's back up to test the 50. And if you look carefully, I don't know if you can see this, this little red line right here, that marks the price point at which the greatest number of shares over the last 100 trading sessions have exchanged hands. That typically marks if you're below it, marks a top. If you're above it, marks a bottom. Um, so, but that's up there, right? That's about 553, 554, and you're down here at 526. So, yeah, pretty good trade from there. But the way it's set up right now, it looks like it's going to come back in a little bit. Okay. I'll take a look at ELF, and then we'll call it a day. Oh yeah, nice. Well, nice in the sense that it's up on a horrible day. And it was really up on Friday, which was kind of a very small gain for the market on Friday. We've got bullish divergence down here off the lower price low, higher indicator low. Big spike in RSI. That's nice to see. And it is not getting above the 21 period moving average. So it is possible that this is simply a little bit of a dead cat bounce off of those deep lows. And it looks to me like those are probably 52-week lows. Yeah. So ELF will get hit and hammered in a recession. So there would be probably some concern about that going forward. The volume in the last couple of sessions, pretty good, right? Above average, I would say. But yeah, that's gonna that's I would have to say this: the high probability gains have already been made by the market off of the bullish divergence lower price low. You got the bounce into the 21. That's your move. If you took that move, if you made that move, I would get out, or at least lighten and tighten. Lighten your shares, tighten your stops. I don't see too much more upside from here, barring some major change in the overall economy and tariffs coming off and all of that. But I got to think that a cosmetic company, a retail box retailer, is going to really struggle if imported goods come with a 25% price hike. So just be aware of that. The move looks great if you got in a few days ago. Not so good if you're wanting to get in right now. All right. I'm going to go, guys. God bless everybody. Have a great rest of the afternoon. I'll be back in the room after I produce the video. Bye for now.